Money, 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 money. That's right, guys. Unit 4, all about money. Now, you're not going to pick this up in your notes. This is just some background information. I'll tell you when to pick up your notes. But money is the measure of value. So if you think back to our first unit, value equals scarcity plus utility. So how rare is it and how much is it used? Money expresses worth or value in a way that people can understand. Like, how do I know diamonds are valuable, right? Well, we know that they are. All right, so how does money store value? Well, purchasing power can be saved until needed in the future. So if I take out money from the bank, it doesn't mean that I'm using that money at the exact second, but it means that I will be able to use that at the needed time in the future. Money allows time to pass between earning and spending income. Some of the characteristics of money: portability, I can pick it up. Easily transfer from one person to another. Durability, lasts when handled, doesn't easily deteriorate. So if you look at your money, take out a dollar bill or whatever, you notice that you can fold it, you can do a lot of things, but it is difficult to destroy. All right, into our notes. Stocks. That's right, guys. Stocks, stocks, stocks. All right, so forming a corporation. We looked at corporations, among other ways, sole proprietorship and partnership in a way to form a business, but a corporation, let's say you want to form it. So to become a corporation, a business needs to incorporate. Why would you incorporate? Well, it expands your business and to gain capital. That's the money you need in order to continue your business. All right, this is one way how you can incorporate. You don't have to have an initial public offering, but you can have one. So an IPO, or initial public offering, is the launch of your stock onto the stock market. It's the first sale of stock from a private company to the public, and it's one way that you can incorporate. So an example, all right, a small airline wants to incorporate. So they hire a bank like Goldman Sachs as an investment bank, files the necessary papers to the SEC, that's the Security and Exchange Commission, has an initial IPO, or initial public offering. 10 million shares are sold to the public at $50 each, so that's $500 million. So Goldman Sachs takes $5 million for their fees, and the airline has $495 million to use in order to buy planes and to be able to sustain their business. See, it makes sense. So then what's a stock? A stock is a certificate of ownership in a corporation. It represents partial ownership of a corporation. So share of a stock, again, is piece of ownership in a corporation. So now with your $10,000, you own parts of companies. The value of the share changes when the value of the corporation changes. That just makes sense. What's a ticker symbol? It's an abbreviation used to represent a stock. So there are thousands and thousands of stocks, so you got to be able to represent it just by a few letters. Apple, AAPL. Google, Goog. All right, so this is what I was trying to tell you about with your stock portfolio. Portfolio diversification, making different choices, not everything in the same, not putting all your eggs in one basket, basically. Is it a game of luck? Absolutely. A stock could either increase or decrease in value. That's the stock market. That's the game you're playing. Because of this, many people choose to have a diverse portfolio, meaning not all one type of industry. So it means having different types of stock. Why? To set off any declining stock. That's why you're doing 5 different stocks from 4 different industries. How do you determine the value of a stock? Well, you look for the potential growth, reputation, its past history, what has it done in the past, internal and external events. So what's happening in the world around you and what's happening in this business. How do you purchase a stock in the first place? Well, you can hire a stockbroker to buy or sell stocks. You can go through a discount brokerage firm online like E-Trade. There's tons of them. Boom. You have organized stock trades. So this is organized security exchange, a place where buyers and sellers meet to actually trade stocks. So you have the New York Stock Exchange, you have Amex, you have NASDAQ, you have all these different exchanges, mainly on Wall Street in New York City. So I want to learn more about the New York Stock Exchange. It's the oldest, largest, and most prestigious stock exchange in the United States. It lists stocks from over 2,800 companies. That's a lot, by the way. Then you have American Stock Exchange, or Amex. It's also prestigious. Companies on Amex are smaller than the New York Stock Exchange. It only has about 750 listed stocks. You also have over-the-counter markets. So this is an electronic marketplace for stocks not exchanged in organized stock exchanges. The best example of an OTC is the NASDAQ. It's the National Association of Securities Dealers Automated Quotation. That's right, it's way easier just to say NASDAQ. This is the largest electronic stock market, and it has mostly tech-related companies. We have some ways that we measure stock performance in the first place. So you have the Dow Jones Industrial Average, Standard & Poor's 500, sometimes called S&P 500, and bull versus bear markets. One of these. So Dow Jones is the most publicized and popular measure of the stock market performance on the New York Stock Exchange. So it'll tell you how much is up and how much is down. It looks at the stocks of the top 30 corporations. Standard & Poor's 500s, or the S&P. It looks at the prices of 500 different stocks. And it includes stocks from New York Stock Exchange, Amex, and NASDAQ. All right, you're going to hear people talk about bear and bull markets. So a bull market is a good market. It's a strong market that's moving up. So you always want it to be a bull market. Versus a bear market is a bad market. It's a mean market with falling prices. So that's never what you want. All right, wrapping it up, looking at financial assets. So we have different kinds of financial markets: capital markets, money markets, primary markets, secondary market. Financial markets. So you have capital markets, which are a market where money is loaned for more than a year, versus a money market, loans of less than a year. A primary market is a market where only the original issuer can redeem a financial asset. Versus a secondary market, financial assets can be resold to new owners. So just as a word of caution, risk and return. Investing money comes with risk. You do not know what the outcome will be. Savvy investors only take risks when the return is substantial. So what's your objective in investing? Why are you investing? Is it retirement, long-term, slow payout? Is it a vacation? You want to be able to go play the slot machines? How you invest is based on why you invest. Sure, you invested $10,000 in the stock market because I told you to, but now you have a real choice to think of, how do you want to play this? Your goal is to make the most money in the next month. KISS is an acronym and a crappy band from a long time ago. Investors like to KISS, or keep it simple, stupid. I really hate that acronym. I'll explain. The more involved with an investment, the more that can go wrong. Okay, let's just change it to keep it simple, silly. Huh? Isn't that better? Simple investments are the best. If it gets too complex, ignore it until you learn more. If you don't understand your investment, you cannot expect to make more money off that investment. If it's too good to be true, it probably is. and consistency. Rather than go for a big payout, smart investors invest slowly over a long time. Again, you want to be able to see how things are doing over a long period of time. All right, guys, I hope you enjoyed this video. Good luck.